NVIDIA, Oracle, OpenAI, Meta, and they're investing money into each other. How much risk is there?
Oh, I mean, that's the thing we're all trying to figure out at the moment. There's so much information that's coming through. This is happening at a very, very fast pace. And so, you start to look at these things and go, well, does that make sense? Is that just inflating prices all the way up as that circular economy is flowing through? My honest answer is...
We are back in your life, and today I've got Chris from Mapua Wealth. Chris is our research house here at Lighthouse. Essentially, the way this works, Chris, is I'm the pretty face of the operation.
You are.
I talk to the people. I got Mike off on the Milford track. I don't even know if he's going to return, to be honest. So this could become a full-time gig for you.
Well, hopefully. Well, let's see how we go.
Yeah. So we're doing our quarterly update, and I thought, who's better to talk about than having Chris along, because essentially Chris helps us in terms of kind of looking at all the funds, all the options, all of the new players that are arriving into the market. Chris, there's always, especially in New Zealand, right? It seems like, because our market's quite small, but as KiwiSaver grows, there's more and more options.
Always lots going on. Lots going on. Plenty to discuss today too, James.
So this is for, so we're going to talk about, we've got our investment clients that we're also using this as a newsletter to talk about performance, and then just generally for all of our listeners, I guess, about what's happening in the world. This is from the 1st of July to the 30th of September, is that right?
Correct.
Yeah. So a little bit of a time lag. How would you describe that quarter in terms of from a financial markets perspective?
I would say, it was a very, very strong quarter for clients' portfolios. Up until September, markets have been really strong since, actually, if you go back since, remember Liberation Day, the tariff announcement, kind of late February, early into March. Markets started off pretty abruptly then, but since then they've been up very, very strongly and continue to kind of exceed expectations.
Yeah, I mean, you look at it now, right, and you go pretty much everything in the green over the past quarter. You look at the S&P 500 and it's up like 100% over the past 5 years. Is it all too good to be true at the moment, Chris?
It's actually, if you look at the performance of companies that are generating these returns, a lot of that is coming from very strong earnings growth. So there's real profits from these companies. You can go back and look at other periods of time when there was a lot of leverage in the system, maybe, or companies were not profitable at all, and the share prices were going very, very high. So there's some good common financial grounding in what we're seeing today, if that's even a term. But what we're seeing is, but markets are very, very strong, and certainly anyone expecting these returns to extrapolate into the future should be very, very careful. Yeah,
because I know when you look at, that's the conversations I'm having with clients at the moment. I'm like, yeah, it's great. We'll take it when we can get it, but do not expect it to look like this going forward. And even some clients who are getting closer to like wanting to start to take an income from their investments, I'm going like, it's harder to talk them into going, I've already been telling you need to drop your risk profile. You really need to drop your risk profile now. And they're like, wow, what if it keeps going? But it just, I mean, everybody will have an opinion in terms of why markets are so strong. But just give us your thoughts. What is happening at the moment? Why are markets performing as well as they are? Okay, well, we've seen, everyone knows about the AI boom. Everyone's been, we've seen all the numbers around ChatGPT and Copilot and all the different ways that people are accessing AI. And, it's genuinely quite a disruptive influence on the market for positive at the moment. It's meaning a tremendous amount of capex is happening, especially within the US at these large technology companies. That's leading to strong employment numbers. You're seeing a lot of earnings per share growth coming from these companies as well. So it's very real. You could also say that globally the economies are actually looking relatively solid too, and by that I mean look at the US, other parts of Europe, they're growing. Unemployment's relatively low, especially in the US. Inflation has been moderated since the peaks of what we saw in 2022, 23. People are more comfortable with where inflation is at the moment, which is also positive for markets. So we've got this
period at the moment where things are looking really good. And then if you think about the whole behavioral economic side of things, we kind of get the animal spirits coming into play here. And you're definitely seeing just a lot of activity, a lot of hype, retail investors coming in a big way, and people really pushing prices up and up and up.
Yeah, are the retail investors like the DIY investors? Because obviously with the rise of Sharesies, Robinhood in the States, I'd always had the opinion that I guess wholesale money was just so much stronger and so much more influential. Is it getting to the point at all that that these DIY investors are having like a larger percentage of the market in terms of flows in and out?
Yeah, there's a couple of things driving markets around flows at the moment. One is definitely you are seeing more of an influence from smaller investors, going onto Reddit, different places, talking to each other, sharing ideas. You're seeing the meme stocks go up in a big way. And they're, a lot of those kind of meme stocks don't have the fundamentals I mentioned before about profitability, strong earnings growth coming through, or, can be optimistic about the outlook. So they seem to be very speculative. There's a lot of money moving into passive funds as well. And what you're doing when you do that, they're all skewed more towards the largest companies because they're market cap weighted. So money flowing into passive funds tends to push the larger companies up as well. So that's definitely a dynamic that we're seeing too.
There are those that kind of have some beliefs that if everybody is in a passive funds, what even is markets? Is there a point that there's a tipping point where there's too much money in passive funds? Like, do active investors always have to have a place for markets to work the way they're intended?
Yeah. Okay. So I'll try and keep this short. We can have a really detailed conversation around this. But the whole point about markets is this whole idea about price discovery. So the idea is that, investors come out, information comes out, the market quickly digests that information and looks at whether it's positive or negative, and that will impact the share price. So you want active managers coming in, having a view about this company's looking really, really cheap, but I think it's going to have a really strong earnings number coming out. I think there's some positive upside to come that the market's not factoring in, and I'll buy it. And if you go back for many years, there are more active investors in the market, many more than passive funds, but with a huge rise that we've had of passive funds. And we've seen it here in New Zealand with Kernel and Simplicity and the like as well. You've got less, I guess, price discovery happening in the markets. And we don't really know what the impact will be, though. There is now data to show that there's more passive investors than active investors. So that might skew things a little bit. One potential outcome is that we get more volatility, because as people flow into these things very quickly and push the prices up, they can also flow out very quickly and push the prices down. That doesn't mean that it's a better environment for active managers per se, just to be clear. It just means there might be more volatility.
Oh, yeah. Trust me, Chris, if there's one thing I've learned about the comment section, the ETF bros will be in there. And this is not saying that active or passive is good. It's actually just interesting, the trend and how markets respond to the trends going forward. Speaking of trends, are markets overcooked at the moment? Like, if you look at it, 17% per annum over the past 5 years for global shares. We know the long-term average is 10%. Is really high compared to like that long-term average. Does that concern you?
Yes. Markets are looking really expensive right now. And it's not just the US, actually. There's a lot of other markets around the world where, they're at very high, if you look at any type of valuation metric, price to earnings ratios or what have you, they're looking very expensive. And we know that if you look back over time, and you can look back over many, many decades to see these different trends in different markets and how they've performed in different scenarios. We know when we get this very high peak that we've got right now, you tend to have that mean reversion, which is basically coming back to what a long run, type of market valuation should be. And so right now, markets are looking very, very, very expensive.
The dangerous piece here, right, is so we've gone, markets look really expensive compared to long-term trends, and people are like, no worries, lads. I'll pull my cash out. I'll sit on the sidelines.
Totally.
The risk is like you look from 2008 to 2020, right?
Yeah.
And there was, I don't know a bunch of recessions called that never eventuated. There's just not the risk that markets are overcooked.
Correct.
There's the risk they run further. People sit on the sideline. And then actually by the time they've dropped, they've already gone up quite a lot more.
Exactly. And that is absolutely the point. The whole thing is, okay, markets are looking really expensive. So what should you do? And there's a number of things you could do. Like you could just say I've got, next 20 or 30 years to invest. I'm just going to write it out. I write out the volatility. It can actually work in my favor, especially if I'm a KiwiSaver investor or a regular saver. And I'm just tipping into the markets. It's expensive right now, but as they come off, when they do eventually come off, you'll do well. A lot of people got very defensive 18 months ago. And actually they've missed out on 20-30% returns at least over that period. So you've got to be really, really careful about timing things. And I can talk through how we view that and what we like to do. But as a standing point, we know the difficulty around forecasting. Where the market is going to go, especially over the next 1, 2, 3 years. And it's a fool's errand in our view. It's just very difficult to forecast where these things are going to go. So there's things you can do, I think, to tilt the odds in your favor. But at the same time, we certainly recommend staying fully invested.
And the other interesting thing within New Zealand as well, right? Because essentially it's been a double whammy because you've had global markets going up so much, but also the New Zealand dollar dropping. And if you've just not thought about it at all and just bought some shares, you're like, this is working out amazing. But there's almost like twice the risk at the moment, because I know just because the New Zealand dollar is down doesn't necessarily mean it's going to go up. But you do look at like a 5-year chart and you go, well, that's interesting. And then you look at global shares and you go, well, that's gone up. Well, that's interesting. And if you overlay those two things together, the returns really start to move.
Absolutely. So, I mean, currency, that's an even different ball game. And I think that's even harder to forecast. To be honest. And you've got to remember as well, the whole point about forecasting is people are trying to, they're looking at where will markets be in the next, 1 month, 3 months, 6 months, a year. And so many things can happen that are just totally out of our perspective that we might want to think about and look at that will have a larger influence on markets than we can ever expect. So currency is really difficult. As you know, well, we have a large allocation within our portfolios to global shares, and it's diversified across a number of different strategies. But because there's such a big bias to global equities, we do think you want to be taking into account some of the currency risk. So at the moment, we've got a 50% or thereabouts hedging strategy in place around our offshore assets. And
for those that don't know what a 50% hedge means, can you just really tell me, like I'm a 5-year-old, what that means?
Okay, so you're holding a basket of, let's just say, US equities as a starting. Well, US equities, European equities, Japan, Asia, and different places, and you're investing into those economies. So you can have the share price going up 10%, but if the New Zealand dollar also goes up 10%, you return zero. So the currency is having a really big influence on returns. You could have the share price going up 5% in currency, going up 10% and you're negative 5%. So you've got to be aware of the impact of currency and how that's going to actually influence the returns that you'll be getting when you convert it back to Kiwi. And so what do we do? So we invest into funds where they actually hedge out the currency exposure. So what do? They buy the companies they invest into. And you can do it across, fixed income, property, different areas. And all they do is they go, I'm just going to basically convert that back into the New Zealand dollar. And they do it through forward contracts, which I won't go into.
No, we'll stay away from forward contracts.
Typically, it's a way to actually just hedge out currency risk and actually have it back in the New Zealand dollar. So you still have those investments overseas, but you're just reducing or mitigating any currency impact.
Yeah.
Now, if we can go into this a little bit further, currency can be a good thing as well. So it can totally work in your favor. So we've seen back in 2022, also 2008 when we had the global financial crisis, and other areas where the New Zealand dollar tends to sell off during those periods. And we're more of a commodity type country. We're a small country. You have a flight to safety. It goes to the US and other markets instead of ours. And that's great for your offshore portfolio. You've got a portfolio of shares over here, the currency falls, it's now worth more. So it's worthwhile having that currency risk. You just want to think about how much.
Well, I'm quite interested. So we've talked a little bit about the currency piece, where markets are. When we talk about markets performing really well, that's mainly to do with the US. And when it's to do with the US, it's mainly to do with a few companies. And I'm very keen to get your thoughts on the US market and AI in particular, and we'll do that after this break. If you have a sum of money and you're like, I'm not sure what to do with it, where should I invest it? Property, shares, should I look at sharesies, whatever it might be. At Lighthouse, we're independent financial advisors. We won't just talk to you about shares and building a diversified portfolio, but if you want to talk about property, maybe paying down debt, and most importantly, putting a financial plan together to achieve your goals, click on the show notes below, book a free 30-minute chat. Now, back to the episode. Chris, AI, the question, are we in an AI bubble? I am very keen to get your thoughts. What do we reckon?
Okay. So we're in an environment at the moment where there's a huge amount of interest in AI. There's a huge amount of money flowing into it, and as a result, it's pushing a lot of companies, up much higher. And there's just a lot of hype around it. And this is not new. That's really important. So we can go back and we can look at all these different periods of time where, there was a systemic change in the market and new technology came in that would totally revamp how we work, how we live, and improve productivity, improve our lifestyles, all these different things that AI is promising to do. Go back to the early 1900s, and railroads being introduced was a huge impact on freight. Being able to move around, much more seamlessly, especially around different countries and different places. The motor car obviously coming into play was a big deal. Fast forward to the 1990s when the internet came up, a huge impact on the markets, on again our lifestyle, how we consume information, and how can make improvements to how we work. And what happened then, especially, there's a huge amount of investment into fiber optic cables, which was all about the information highway, just putting that down. A huge investment went into that, which we're benefiting from today in terms of the ultra fast broadband that we have. You can then obviously, look to now what's happening with AI is a really big deal, and there's no doubt about it. The problem you have is when you look back at those episodes I just mentioned, the railroads, the technology, internet coming into play, that most of the leaders in that space didn't actually end up being the ones that benefited the most and the best performance or best share price returns. Here's a great example for everyone. So Microsoft, listed in 1985 or thereabouts, someone can tell me if I'm wrong, had a pretty good performance run to the 90s especially, and then peaked in March 2000. And then had a negative return, lost about 40, 50, 60% because of the bubble, because prices were just so inflation. There was so much hype around what that company could do, and the reality was much different. And it took you until 2015 to get your money back.
Wow.
So there was actually this period where you had they actually talk about the 2000s being this lost decade, because the technology bubble peaked in March 2000. And after that, you also had the GFC in 2008. You had this period where US equities actually had a negative return over a 10-year period, over a decade. And that was because there was just so much people just have this very high expectations about how this is going to transform our lives. And we often do that. We've got these, we overhype things over the short term, and we don't actually understand the true impact over the long term. And where you get as people where this, they talk about irrational exuberance, if you want to have a term that people use back in the technology bubble, where people just get ahead of themselves. And there's a very risk that we're seeing that today with AI. You're seeing huge capex spend, but not a lot of revenues coming through yet for a lot of these companies. And that's a big deal. You've got, if you're thinking about the microprocessing chips, they've got to be replaced every 2 to 3 years. So the depreciation cost, the cost of actually replacing those chips is very, very expensive. So there's a lot of question marks about how it's really going to influence our lives. I think if you talk to anyone and they'll talk about how they've used ChatGPT to write a new email or draft a letter, help them write something in a really nice manner that they couldn't have done in such a quick, efficient way before. But the true benefits are probably going to be around robotics. They're going to be around autonomous driving, all these other areas, which you'll see winners come through from that. But I don't know if the winners for AI are necessarily the ones that are being priced to perfection today.
Very interesting. And what about when it comes to, so you've got NVIDIA, Oracle, OpenAI, Meta, and they're investing money into each other. How much risk is there?
Oh, I mean, that's the thing we're all trying to figure out at the moment. There's so much information that's coming through. This is happening at a very, very fast pace. And so, you start to look at these things and go, well, does that make sense? Is that just inflating prices all the way up as that circular economy is flowing through? My honest answer is it gives me reason to pause for thought and reason to be cautious about how things are going to be performing going forward. But I don't know if it's all like a Ponzi scheme or whatever, and they're all just kind of buying each other's to bring prices up. But I haven't seen any information or evidence on that yet.
And what about when it comes to so there's a lot of focus on the Magnificent Seven, these big companies. I also wonder about is it undervalued the impact on the normal business that's actually not like an AI firm, but can use say Lighthouse, for example, can leverage AI to become, have better communications with their customer, give them a better experience, be able to process more work in a more efficient way. Do you think that's been underestimated outside of the AI companies?
Yeah, so this is my very uneducated view on AI, which is exactly what you say, where I think the winners are quite broad, and they're going to be, financial services, or service firms in general, whether it be lawyers, accountants, financial advice. Obviously, hospitals are going to be huge benefactors of it. If you look at any industrial companies as well, factories, automation, all these different things. So the fact that all the hype is going around these kind of digital communication companies and all these other things, to me, just doesn't really quite add up at the moment. Now, again, these companies could keep on going. NVIDIA, the $5 trillion business, can keep going up for some time. Yeah, I've got no idea where it's going to be in the next few years.
Yeah.
But I do know that the expectations that people have extrapolated into that share price value is just kind of goes beyond any common sense.
Yeah. Okay. I mean, that's really interesting, right? Because it's your job and your full-time thing to try and understand markets, decide how to build a diversified, managed portfolio. I know that you're underweight when it comes to US shares at the moment. Can you talk a little bit about, because there's just the logic of going, this must be overpriced based off these key indicators in the past, but what if you're wrong?
Yeah, right. It's a great question. So if I can just take it back a quick step. So our approach to how we look at markets is to be is to take a long-term view, but where we see these periods of pockets of overvaluation, pockets where we think our clients could actually benefit from having a slightly different position, then we'll put it in. And we can be quite active in those areas. Going back to 2022, when interest rates went up very quickly, we were very active in our fixed interest part of our portfolios to protect the investors from the negative returns that many others had. So what have we done within our global equity portfolio? So earlier this year, we looked at the weight that our clients had to US shares. And if you're looking at a global MSCI World, a global portfolio, there's about 70% weighted to US companies. If we look at the underlying valuation of US shares, it was getting up to historical highs as well. And then we looked at other markets around the world, whether it be Europe, Asia, and we saw those markets being much more fairly valued. And we just had better outlooks, better expected returns from those markets as a result. So we actually decided to reduce the US equity exposure and have a bias and overweight to Europe and Asia. And what we did is when we went through that process is we decided to cap the US weight. We'll have a US weight of around about 50%. So still quite a decent allocation to US companies. It's just not 70%. And that means that I fully expect US companies to still do well over the very long term, and we want to have some exposure there. However, we think it's prudent to actually just, from a risk management basis, be thinking more broadly, more globally, more diversified across other markets. And it's actually worked out quite well for our clients, even though the US market has run up really quite strongly, as you would have seen for your portfolio performances for your clients. We've had markets like emerging markets do pretty well. Japan's done pretty well. Europe's actually been quite good too. So it's not only US equity story, and that's really important from our perspective.
Yeah.
So that it just reduces the risk that you have to one economy, one country, even as big as the US is.
Slightly divided at times.
Yep. But it, and I think it leads to a more balanced portfolio overall, a more diversified portfolio with different return drivers that we actually think will give better outcomes, better performance for our clients.
Yeah. Okay. I got another. I'm trying not to make this too technical, but as you talk, I do find this fascinating. What are your thoughts on those who actually go, countries are irrelevant now? Like, we're a global economy.
Yeah.
Like you look at, I don't know, Rocket Lab, right? For example, they're based in the States, but have like a New Zealand presence.
Yeah.
And all of these, NVIDIA, OpenAI, Meta are all global companies.
Yeah.
Doesn't matter what market a company is listed on?
Yeah, it does actually, funny enough. And so, everyone talks about this US exceptionalism, and we've definitely seen that, but it's very much focused at the mega cap, the high, end of the US equity market. And when I say mega cap, I mean the biggest companies, and that's your Apples, your Microsofts, Nvidias, Netflixes of the world. And they're truly global companies when you look at about them. But when you take a step down from those companies, and you could look at banks, you could look at energy companies, you could look at global brands, whether it be Colgate or Nestle and different companies as well. And you actually find when you look at across different markets, you do have some differences in valuations. And that will have an outcome, all else being equal. If you can buy something cheaper, that's got a strong, robust earnings profile, it's profitable, low debt, all these different attributes, you should get a better return from it. So yes, the world is more global now, there's no doubt about it. But you still get regional differences. One thing, remember I said the lost decade of the 2000s, US equities, I think they were like, per annum, they were like negative, let's say 0.5% per annum over that period. So you're basically, they call it the lost decade. Emerging markets, 10% per annum over that period. So, you can have regional differences. Europe, I think, was up about 4% per annum over that period. You can have regional differences where you actually get better results. And I do think you want to look outside.
It's kind of like when New Zealand was a rock star economy, right? And you actually look at, you're like, oh, I forgot that happened. And the NZX was performing incredibly well for a period of time. And now everybody's like, the NZX is a joke. New Zealand's economy is going nowhere. You have to invest overseas. It's very funny how short-sighted we can be.
Very short-sighted. What was it? I forget if it was like 2020 or 2021. The 15-year return of the NZX was higher than the US share market.
Chris, I want to go through a few graphs before we wrap up.
Sure.
The first one is, I guess, an asset class view, and you've got like a rating from minimum to maximum across gold, federal fund rates, US markets, oil, Bitcoin, US dollar index, US property. Can you, there's quite a bit going on here. Can you a couple of things that you find interesting in this graph?
Yep. Okay. So when I look at that graph, and we liked, as you know, we get a lot of information from various fund managers and research groups and data groups, and there's always some interesting ways that they actually can put a lot of data together, but in a really nice digestible design where people can actually glean some insights from it. What's the first insight I have from that graphic is that apart from energy, everything's sitting very much near the tops in terms of valuations. So that's the first point. And that's that whole point about, there are a lot of parts of the market that are looking quite expensive at the moment. And that means we've had a really good performance run. Investors have done really, really well. But that might also mean that things go a little bit ahead of themselves. And so, on the forward-looking basis, the returns might be a little bit lower. I
think oil's quite interesting within there.
Oil is very interesting. So oil's quite cheap, isn't it? And
you've still got a war happening in a very important part of the world, which impacts oil prices. Yep. And then there's all this conversation about energy as well, which is...
energy demand. So we don't even talk about that with AI, but that's a really big deal. So at the moment, the power consumption from all the different of AI in general is tremendous. And so we are seeing a huge amount of energy demand coming into play from corporates and having to set up these data centers and all these other things, and create and look at different sources of energy to actually run them. And you're still seeing a dependence on oil and gas, but it's actually stayed pretty low. So that's I don't know what to take from that, if I'm honest with you, apart from the fact I think it's a good thing because it's so important to our economy, and that should also keep a lid on inflation if it keeps down as well, which is it's a big factor into inflation.
One more question on this first graph. So I look at who is at the tippy top of the maximum, and it is gold. Tell us about gold.
Gold has been one of the best performing parts of the market for the last year or two. And it's really interesting because gold goes back, hundreds and hundreds of years. It's the original store of value. And you definitely see it spike when you have periods around, politics that can spike around wars and things like that. It's the ultimate, value of money. It doesn't give you an income. It's very difficult to actually, how do you actually value what gold is worth? But what we've seen over especially the last 12 months or so is central banks around the world, including the Chinese central banks, which is the government-funded bank that sets interest rates and all the other things and policy and that around the economy. They've been, all their reserves and the amount of money they have, they've been converting that into gold. So the Chinese central bank was one of the biggest buyers of US government debt for many years. And they're now buying more and more gold as those they expire or they mature, I should say. So and also you're just seeing at the moment, I think, a lot of uncertainty around the world, and so people are flocking to gold as well. I like gold, but I struggle with it as an investment strategy. We actually have it in a number of client portfolios. We put it in when interest rates were really, really low, but there's no doubt it's had a very strong run.
Can you use Bitcoin the same way you use gold as an alternative asset within a portfolio?
No.
Why?
Well, because inherently Bitcoin's much more volatile. It's had a much shorter track record or period where it's been around to actually see how it's going to perform in different market environments. Gold can often do well if the US dollar's weak. There's other elements that can come into play when you're looking at investment in gold. And it's not nearly as volatile as what we've seen from Bitcoin and other cryptocurrencies either. So the point being, I don't think we've got enough data. I don't think we've got enough information to actually see how crypto can be used in a diversified portfolio versus gold, which has been around since day dot.
Do you keep an eye on any data of obviously the purpose of Bitcoin is going it can become the currency that everybody ends up using. Are you keeping an eye on, how is that uptake going? Is it getting, because people are using it as a store of wealth and as a asset, but are they using it more in their day-to-day life?
I haven't seen a lot of informational data on this, but you're definitely hearing more about, Bitcoin ATMs and different places where people can get money out. There's obviously been a number of exchange-traded funds that have been launched. We can buy Bitcoin, so it's been easier to kind of get access to for your average investor. You got to remember, going back a couple of years, it was very difficult to actually get access to Bitcoin and all the security around password protection, all these other things, and storing it safely, and all the stories around people who didn't do that, who forgot their passwords or, got thrown out in their hard drive and they've lost it forever. That's not an asset class to me. It's just far too speculative. There's no regulatory oversight for it either, and that's one of the positives that a Bitcoin enthusiast will tell you about. There's definitely positives from digital currencies. And if you are in a country where you need to get money out of that country or transfer wealth in some way, shape or form, I can see tremendous benefits for it. But, the risk of a lot of your enthusiasts that listen to this podcast hating on me for this. I also see the black market where I just think it's not doing any good. I think you want to have currencies like this, I think there should be regulatory oversight so you can have confidence in them, how they're used, how they're priced, how they run. I just don't believe, and so until that happens, I wouldn't be that comfortable investing into it.
Chris, we might jump straight to, you've put together this really interesting graph of the performance of different assets over 1 year and then rolling into 30 years.
Yep.
Can you talk us through this? Because I think this is a very good reminder of what happens to markets.
Yeah, so we looked at the, we went back to, as far as we could go back, and I think it was back to the 1970s, and we said, well, if you're an investor, and you've invested your money, at the start of that period, and then you look forward over the next 30 years, how have you invested, and then you just price it forward from there. So what is it? Like 1995 would be the last investor that kind of came into that. But you can look at the different outcomes that they've had over that period. And what does it show you? It shows you a couple of different things. Over those first few years, the performance is highly volatile, and it's all about that starting point. So you might come into the markets and you might come in with a very strong 1 year return and it keeps going up, or you might come in with a period where the market sells off abruptly straight after that. The point we're trying to make from that graphic is that if you hold for the long term, the longer you hold the asset, the more you actually get the return dispersion coming in and narrowing over a period. So I think if you look at it over, the first point I'd make actually is that if you're investing into global equities, you would, over about 5 or 6 years, you tend to actually have a positive return no matter what. So I think that's a good thing. People worry about investing into shares, into listed companies, into equities. They worry about the volatility and what happens if I come in and the market sells off abruptly. Well, if you hold it for 5, 6, 7 years, you're going to typically be positive. And then the longer you hold it, the better the return's going to be. So we've also seen the other point that I think is really interesting is that, if you hold it for 20 or 30 years, that dispersion in returns from the lowest possible return to the highest possible return is something between like 6 to 11% or something, which is a decent bit of a range, but it still shows that the worst investment outcome is a 6% return per annum, which is not, typically that would be above cash, not a bad outcome.
Yeah. I just believe in really reverting to the mean with everything, right? Is that when you look at US shares, when you look at the New Zealand property market, when you look at the NZX, like the only thing that is guaranteed is good times and bad times don't last. It will revert to the mean at some point.
Absolutely. And that's a buy and hold strategy. So if you actually invested your money, but you're a regular saver, which is what KiwiSaver is, and others, you would have a better outcome without doubt. Like you would definitely have a better outcome because you're constantly investing into the market at different periods, and you're especially investing into the market when you have spikes down. And volatility is really, really is your friend. I mean, we talk about the power of compounded wealth.
Yeah.
Averaging into markets or investing into markets when they're moving around is also a very, very powerful way to actually improve your performance. Get good outcomes.
For sure. Okay, I've just got a few numbers I want to hit off in terms of performance of portfolios. So these are for our Lighthouse portfolios with the support of Mapua Wealth on the research side. So like if we look at a moderate portfolio, which is 40% in shares and property, 60% in cash and bonds, the 8.6% return over the past 12 months and over the past 5 years, 6% per annum. If we jump to a balanced fund, 11.5% for the last 12 months, 7.5% over the past 5 years. And if I jump all the way to, let's say, a high growth fund, 16.4% over the past 12 months, 16% over the past 3 years, 11.1% over the past 5 years. It's actually interesting looking at those numbers, Chris, and you actually go, even with markets being as strong as they've been over the past 5 years, it does pull that kind of return back to you, because you do forget even over 5 years, there have been some periods of volatility and negative returns.
Absolutely. I mean, we had 2022 where the market was down 20, 30%. You also had that period where fixed interest also, that period we've had interest rates, certainly in New Zealand, go from 25 basis points up to 5.5.
Yeah.
And then obviously down to 2.5 now. But that period where they went up from 0.25% up to 5.5 happened in a very short period of time, and actually had a very it leads to fixed interest returns and cash returns, but fixed interest returns over that period are like 1 or 2%. So that's why the moderate portfolio over that 5 years is 6%, because it's got a bias to that part of the market. Still done pretty well, but it's it's been tricky.
Awesome. Okay. Well, Chris, thank you very much for joining us. I've really enjoyed this. Let us know what you think. I'm always keen to trial different things. Really keen for your feedback in the comment section. Did you enjoy this? Was this a little bit too technical? Do you just want us to bring Mike back? For my vote, Chris, I really enjoyed it. So thank you for your time.
Thanks, James. I really enjoyed it too.
Okay, well, we'll wrap it up there. Please make sure to subscribe to the channel, give us a review, give us a like, and we'll catch you next time.